Hi everyone, my name is Anuj Jindal and today we are going to start with a new series wherein I will be discussing I repeat, the entire Ssc Aao paper for 2018. It was held in February 2018 and it was actually for the year 2017 but held in the year 2018. We will discuss in detail the entire paper. We will touch upon all the concepts. I'm not going to just uh, have a look at the question and show you the answer. I'm also going to discuss the principles behind every question, the concepts behind every question, and therefore the lectures are going to be longer. So I'm going to cut short the lectures into smaller parts. We'll be discussing 5 to 10 questions in every lecture, but the questions and the explanation is going to be very important for all those aspirants who are thinking about giving SSC AAO examination in the year 2018. And it's a very important examination. It's a very important post because it is one of the most prestigious in the entire SSC paper that is conducted every year. I have done BCom honors from Delhi University Hindu College. I have done MCom from Delhi School of Economics, and I also have a JRF in Commerce. I worked in SBI as a manager for a brief period of time. Therefore, I have the academic as well as the experiential qualifications to delve into the concepts of accounts as well as economics. So I believe I can guide you very well in this particular area, if not anything else. So I will be going through every question one by one, each and every question one by one, and we'll be discussing all the concepts and related to those questions. So let us start with the first question. The first question that was asked was, if the partnership deed is silent, then what is the minimum salary or other remuneration paid to partner every month for taking part in the conduct of business? So this question is related to partnership. Now partnership is mentioned properly or mentioned comprehensively in class 12th book, which is by D.K. Goel. There are other books also by T.S. Grewal. There is a book, and then there are NCRTs. So you can refer to any one of these books. All these three books are good enough. Class 12th has two books normally. So D.K. Goel book is the one that I refer to because I found it the best, and the entire partnership chapter is mentioned there. And in that chapter, you will come across an area wherein there are rules which are given, which are applicable in the absence of a partnership deed or when the partnership deed is silent. So what happens technically when the partnership deed is either absent? What we mean by absent partnership deed is that the partnership deed is not there only. The partners who came together did not write anything or did not have a deed, or it is a verbal agreement. For example, I I enter into a partnership agreement with another person, and let's say with my brother, and the partnership is to open a restaurant. But because we are brothers, so we do not enter into a written agreement. We just have a verbal agreement saying that okay, 50% will be yours, 50% will be mine. This will be the capital contribution that I will be making. You will make the rest capital contribution, and then there will be certain profits and certain losses, and this is the ratio in which we are going to share those profits or losses. So it's a verbal agreement. There is no written document that has been created, and therefore the rules in this case are going to be different than what they would have been if the partnership deed or if the agreement would have been in writing. So in case of absence of partnership deed, or when the partnership deed does not talk about anything, then what are the rules that they apply? So those rules are provided in that book. One of those rules is related with salary of the partners. So if the partnership deed is silent, or if there is no partnership deed, if there is a verbal agreement, then there is no liability on, or there is no obligation on one partner to provide a salary to the other partner if they go to the court with their and if they don't agree on something. So in case of absence of a partnership deed, or if the partnership deed is silent, there is no salary that is required to be paid. You don't need to pay any salary to the partner, and therefore the answer is 4, no salary. Now there are a lot of rules which have been provided. Let me simplify those rules for you. So those rules can be divided in the following parts. Number one, there will be rules related to interests. Now what are the different parts of interest? When we're talking about interest, then there are 3 4 parts. Number one, interest that is to be paid by the partners on drawings. Drawings are money that is taken out by the partner from the business. For example, I need 2 lakh today, and I go to my brother and I say I need this money for something, some personal expense, and I want to take out this money from the business that we are running together, the restaurant that we are running together. My brother says, okay, so these will be your drawings, but you have to pay certain interest on these drawings. So that is an interest on drawings. Then you have interest on loan. For example, the partner provides certain loan to the company, loan to the business that they are running, and then there is interest on capital. Capital is initial contribution that the partners make when they come together. That will be capital. So there are certain interests on these three things, and there are certain rules related to these things. I'm not delving into the rules because they are very detailed and they'll take a lot of time. The next is salary to a partner that we've already discussed. Then there are the rules related to admission of a new partner. When you try to admit a new partner, for example, we two are brothers, we came together, opened a restaurant, started it, it's running fine. A professional comes in 2 years later and says, okay, I also want to partner with you, let's expand this business, let's have another chain of the same restaurant business that you're running because it's going on very well. We say, okay, so you're admitting a new partner. And then there is profit sharing ratio. What are the rules related to profit sharing ratio? It will be 50-50 in case of no partnership deed, but there might be certain other rules as well in case of no partnership deed, and we'll be talking about all those things when we start with the course on AAO, accounts as well as economics, which I'll be doing immediately after we are done with this entire series of analysis of past year questions, so that we know what kind of questions and what level of questions were asked in the examination. Let's come to the next question. The second question says, which of the following needs to be excluded from current assets apart from closing stock to get the balance as liquid assets? Now, when you go through ratio analysis, which is also provided in class 12th book that I mentioned, in part B, you have ratio analysis, and according to that ratio analysis, there are three kinds of ratios under liquidity ratios. When you're talking about liquidity ratios, there are three ratios. Number one, there is current ratio. Number two, there is quick ratio, which is also called as acid test ratio or also called as liquid ratio. And number three, there is cash ratio. So these are the three ratios that are provided in the liquidity analysis or liquidity ratios in that particular book. Now, all these three ratios have different formulas. What are we talking about? We are talking about liquid assets. Liquid assets are these. When we're talking about liquid assets, then what we do is we take current ratio. From this, we reduce inventory or stock, and from this, we also reduce prepaid expenses. Prepaid expenses. So these are the two things that we reduce from current ratio: inventory and prepaid expenses. And on the liability side, we have current liabilities as they should have been in the current ratio only. Current ratio is current assets upon current liabilities. So you reduce inventory and prepaid expenses, and the reason for that is because they are not so liquid. In current ratio, you are taking all the current assets which are liquid in 1 year, but inventory might also last more than 1 year if the organization is not able to sell the entire inventory. And prepaid expenses are expenses, actually those are made, those have already been paid for. For example, you paid for an entire year's TV subscription, okay, or internet subscription. So you've already paid that expense in advance, and therefore you're not going to get it back. You've already paid for it, and therefore you're not going to get it back, or you cannot utilize that money in order to pay your liabilities. For example, you paid an entire year subscription of internet, and tomorrow a person who has given you loan comes up and says that give me back my loan. You cannot use that money which you had paid for subscription in order to pay him back, and therefore it's useless. So it will be excluded from liquid ratio. So the answer as mentioned here is prepaid expenses, because we do not have inventory mentioned here. If inventory was also there, that would also have been an additional answer in this. I hope it's clear. Let's come to the third question. Which among the following is a capital receipts? A very, very interesting question. In this question, if you go through the details, you will see that 2 is certainly not a capital receipt, because whatever sale you are making of goods that you're selling, for example, I have a company which sells cycles. So whenever I'm selling a cycle, I'm not selling a capital asset, I'm selling a revenue asset, because cycles are the goods that I deal in, and therefore They are considered as revenue assets and not capital assets. Then you have commission and fees received for services rendered. Whatever services I might have provided to an individual, for example, I am a barber, so I provide services of cutting hair to people. Whatever fees, whatever commission I am receiving for those services, those are revenue receipts, those are recurring receipts, and therefore they are also not capital receipts. They are recurring, and therefore they are revenue receipts. These are also revenue receipts and not capital receipts. What are capital receipts? Capital receipts are receipts that are non-recurring in nature, that are long-term in nature, that are number one non-recurring, that are long-term, and the benefit of which is also to be utilized in a long period of time. So number one, they are non-recurring, for example, which means that you will not have them every year. Number two, they have a long-term advantage. For example, you buy an asset, so whenever you buy an asset, that asset is going to stay with you for the next 5 years, 10 years. Therefore, they have a long-term advantage provided to you. Number three, these capital receipts require a large investment. A large investment. Okay. So these are the major differences. So when we look at profit and loss account, then we will see that dividend received on investments comes under profit and loss account as an income, but whatever amount we receive by way of loans come under the balance sheet. They don't come under profit and loss accounts because it is a capital receipt. When you look at cash flow statement, see, all these are things that I'm not explaining here, and the reason for that is there is not enough time and effort that is required to explain these. So we'll go through all these concepts one by one, chapter by chapter, and I'll make it very, very easy for you. You don't have to worry about that even if you don't have commerce background. So amount received by way of loans comes under balance sheet. It does not come under the profit and loss account because I had given a loan to a friend, and now that friend is giving me that loan. It is non-recurring, right? I'm not going to receive that loan again and again. Whatever I had paid him, he has paid me back the amount of loan. So it's not non-recurring in nature. Secondly, it's always assumed that it is a large amount. For example, if I've given a loan of, let's say, 5 lakh or 10 lakh or 1 crore to a friend, and he pays back that loan to me, so it is assumed that whenever you're giving loan to anyone or whenever you're taking loan, it's a capital receipt because it is assumed that it is a large investment, and it is going to have a long term advantage because just because of the reason that it is a long term large investment. On the other hand, dividends might not have a long term advantage, and the reason for that is that in dividend, whatever, for example, you received a dividend of 1000 rupees or 5000 or 10,000, you're going to use it, or the company is or the individual is going to try to use it as fast as possible because it's an income that you've received. So whenever you receive an interest on whatever investments you make or whatever deposits you make, you tend to use that money because it's an income, and therefore it is not considered as a capital receipt in the profit and loss account and balance sheet. Therefore our answer is 1. The next question says dash is the cost of use of things or services for the purpose of generating revenue. The answer is 4 expense. It's very, very clear. Whenever you're generating revenue, whatever revenue is coming in, you have certain expenses, you have certain cost of those revenues. For example, I make and sell, let's say, bread pakoras. I have a thela and I make and sell bread pakoras. So the expenses related to that are potatoes. Then you will have expenses in the term of bread. Then you will have expenses in terms of gas. So all these are called as expenses because they are utilized in order to generate revenue from the sale of bread pakoras. So the answer is very clear. It's expenses. The last question that we have today is dash states that accounting report must belong to a common period and use common unit of measurement. The answer is B, comparability. Comparability says that the reports of two different periods should be comparable, okay, and there should be a common unit of measurement. A common period is also so let's understand all the different other terms. We have relevance. Relevance is the accounting, whatever we are measuring should be relevant, understandable. It should be understandable to the common man, and it should be reliable. Whatever information we are providing should be reliable. So all these three are not actually related to it. We'll be discussing the principles in detail in the course, which I will start immediately after my completion of this particular course. So, those are the questions for today. Tomorrow, we are going to discuss 5 to 10 more questions, and we'll take the discussion forward and discuss all the 100 questions related to finance as well as accounts as well as economics. And when we are done with the analysis of the entire paper, then we'll start with the entire course and we'll cover entire accounts and economics bit by bit in details, so that no matter you are not from the commerce background, you're going to find it very easy, and you will be very confident in covering the entire paper.